FICO stock has crashed 30% from its all-time highs, but is this just a healthy pullback or the start of something worse? FICO is a company behind your credit score, an absolute cash machine with a near monopoly in its space. But right now investors seem to be running for the exits. Is Wall Street overreacting, or is FICO finally in trouble? Today we're breaking down the numbers, the risk, and whether now is the time to buy or stay far away. Welcome friends to the channel. Today we're going to be covering FICO. I'm going to be covering the financials, the technicals, the risk associated with FICO, and what my opinion is on FICO going forwards. So if you haven't already, please like and subscribe to help this channel grow. Alright, so FICO is one of the leading analytics software company. It operates in over 80 countries. They have two sectors to their business. They've got the scores and they've got the softwares. We've all probably heard of the scores side of things. So essentially FICO, it uses the scores that you get from different companies such as Equifax, Experience, TransUnion. They have different scoring methods, different products. So for example, a FICO score of 8 over here is different to someone that might have a FICO score of 850 because that's a different product. But essentially this is being used by lenders to give loans. So mortgage companies use this, loans companies use this, credit cards use this, so many different companies use it. So within the score side of things, you've got FICO for customers. 90% of top lenders, they use the FICO scores. And then you've got the business side of things. So this is the software side of things where FICO uses the applied intelligence to give the company more analytics. But for the scores, you've got all of these different products over here. These are things that FICO can provide to businesses. So for example, fraud manager, customer analytics, forecaster, etc. Back over here, when it comes to the revenue, just over half of it is made up from the scores and the other half is made up by the software side of things. FICO is a 41 billion market cap company, so it's not one of the big companies with over 100 billion market cap. However, it is going in that direction. It's got a PE ratio of 79, and on its own, again, this means nothing. We have to compare it with where it has been in the past. They've got minimal debt, and every single year they've got growing revenues, they've got growing margins as well. They are growing year on year as well. Even quarterly, the margins are starting to increase, with the last quarter having a net margin of 34%, which is absolutely crazy. When we look at their earnings, it has been hit and miss. So annually in the last 5 years, they have missed a couple of earnings, although very minimal, less than 1% over here and again less than 1% over here. When we look at the earnings per share, they've hit all of their targets except for 2023. And this is just one thing to be aware of. When it comes to things like getting credit, everyone speaks to each other about what's your FICO score. Every company wants to know what's your FICO score. So they have a very big networking effect when it comes to their moat. Diving into some of the numbers over here, as a summary, every single year earnings per share have been increasing, revenue from sales have been increasing, and the shares outstanding have been decreasing. So this is a very good quality company. PE ratio of 77 currently and a PEG ratio of 3.29. This on its own is greater than 1 and it's even greater than 2. Generally speaking, the PEG needs to be less than 1 for it to be undervalued, and anything over 2 is generally very overvalued. FICO has a PEG of 3, which is more on the higher side, and looking at the PEG alone, FICO would be quite overvalued. Some of these other metrics are all flashing red. They have a quick and current ratio of greater than 1. Their assets can cover their liabilities. Over the last 5 years, they've increased their sales by 8%, which is really good. They've also increased their earnings per share by 23% every single year, which is really good to see. And over the last quarter, they've increased their sales by 15%. So far, the sales side of things looks really good. They have gross margins of 80%, which is absolutely really good. And they've got net profit margins of 30%. Again, really good numbers. If we compare FICO to where it's been in the past, the PE ratio is 21% higher than the average of the last 5 years. The price to sales ratio is also 30% higher than where it has been over the last 5 years. Even the price to free cash flow is 6% higher than where it's been over the last few years. But if we delve into the detail of the company and some of its numbers, on this chart over here, I've broken down the revenue even further. In blue, you could see the total revenue made from the scores sector of the company, and that's just been increasing every single year, and it's a nice steady increase. In orange, you've got the software side of things, and that it has been flat over the last few years, although it's been up and down. Since 2021, it has been in a steady uptrend, with the last year only slightly higher than the year before that. Having a look at the total annual recurring revenue, this is essentially a way of measuring how many customers actually annually recur their revenue with FICO. This is started off flat, then it started an uptrend, and now it's starting to flatten out again. And this is one of the reasons why FICO has gone down so much recently, because there's concern about the total annually recurring revenue flattening out. I will cover this later on in the video, but it's just one one thing to be aware of right now. Other key metrics with FICO, in yellow you could see every single year the free cash flow has been increasing. It's a steady uptrend, and the red line you could see is the EBITDA margin, and that has been a steady uptrend as well. So these are really good things with FICO. In the last year alone, they have a EBITDA margin of 43%. This shows how efficient FICO is as a company. However, with all of the good, there also does come some bad. So this chart shows you the price to operating cash flow of FICO. It has been relatively flat, and it has been increasing significantly over the last few years, and it's starting to come back down now. I'm going to add some lines to this. What I've done here is I've added the lowest level it's been, so 13.94. I've added the highest that it's been, and I've added the average that it's been as well. And the lower this number is, the more cheaper, the more undervalued the company is. FICO currently trades at levels which are really expensive. It's much higher than the average, and it's not far off the peak. Although it is coming back down, it still needs to come down more for it to be undervalued. This data goes back to 2015, but if I start it from say about 2020, so you could see the last 5 years, let's have a look and see if that makes any of the numbers different. Even looking at it over the last 5 years, we're currently trading at much higher than what the average has been over the last 5 years. So this does show that it's a very expensive company. And looking at the forward PE as well, it's much higher than where it has been in the past. Moving on to the technicals, we could see that FICO's been in a clear uptrend. Even if I zoom out right to the start in 1998, it's a clear uptrend. FICO is currently trading just below the 50-week moving average, but it's much higher than the 200-week moving average. If I zoom out, there's not been many times where FICO has been trading below the 50-week moving average. Generally speaking, even if I go as far back as 2012, anytime it goes to the 50-week moving average, it's always bounced up from there. There's been very few times where it's traded for long below it. You could see over here in 2018, you could see over here in 2020, COVID, and there's been in 2021 and 2022, this area over here, and then since then it's just been over the 50-week moving average. So although very expensive, it's at very interesting levels at the moment. The next question is FICO a bleeder or not? And what I mean by a bleeder is, how does it perform against the S&P 500? Is it underperforming the S&P 500, or is it outperforming the S&P 500 on a long-term basis? There's a couple of ways to check this. The easy way to do it is by just going on Google Finance, searching for FICO, and adding a comparison to the S&P 500. If I look year to date, FICO is down 15% and the S&P 500 is up 2%. Since the start of the year, FICO's not been doing that good. However, if I switch it to the yearly chart, FICO's outperformed the S&P 500 even over the last 5 years. FICO has done triple what the S&P 500 has done, and even on a longer time frame, FICO has far outperformed the S&P 500. So you could see that FICO is not a bleeder. It's not underperforming the S&P 500. The other way, and the way that I do it, is by just viewing the chart of FICO divided by the S&P 500. And I do this by going on the search box, by typing in FICO, and I divide it by the SPY, the SPY, and I come up with this chart. And the interpretation of this is, if you have a chart like this, and if it's going in a straight line like this, that means it's in line with the S&P 500. So if the S&P 500 goes down 5%, then this company will also go down 5%. And if the S&P 500 is up 5%, then this company will also be up 5%. And that's what it means if it's flat like this. If it's like this, that means the company is underperforming the S&P 500. So that means the S&P 500 is doing much better than the company that I'm looking at. And if the chart is like this, that means the company that I'm looking at is outperforming the S&P 500. So if I zoom out of this chart, since 2008, the overall direction of this chart is like this. That means this company over the long term has been way outperforming the S&P 500, and that's shown by when we looked at it on Google as well. So FICO is not a bleeder. I'll give an example of a company that is a bleeder. If we look at Pfizer, you'll get a chart like this. Since 2001, the overall direction of this chart has been like this. This company has been underperforming the S&P 500 for a very long time. It's been a couple of decades. So these are the type of companies that you want to avoid, whereas FICO is the opposite direction. Now let's talk about some of the risk with FICO. I've already mentioned the risk about the price in terms of FICO being fundamentally expensive. It's trading much higher than where it has been in the past, and it's trading at really expensive multiples. And that's one of the main risks with FICO. And the other risk with FICO is this annual recurring revenue flattening out and essentially becoming stagnant or even starting to decrease. However, going over to the earnings call, when the CEO spoke, they mentioned that foreign exchange had a negative impact on the total ARR. It had a negative impact of 2% on the total ARR and 3% on the platform ARR, because the dollar has been quite strong compared to the other currencies, such as the one in Brazil, which they quoted in this call. However, when we start reading further into it and when we listen to the transcript, one of the questions that the analyst asked is, the ARR revenue was expected to be 30%, but now we're talking about 20%. What's the reason behind that? And the CEO said not to read too much into any particular quarter, and this latest quarter, the foreign exchange had a big impact. The other thing that the CEO said is that in terms of the guidance, they generally provide conservative guidance, that they don't like to give guidance which is too optimistic, which is too out of reach. Interest rate was one of the factors why they didn't hit their targets this time around, but he reiterates that there's no change to the guidance, and the guidance that they have given for this year stays exactly the same. And if we look into this guidance, let's see what the analysts are saying. Over the next couple of years, FICO are expected to grow their earnings per share 22% and 24% respectively, and their revenues they're expecting to grow by 15% each year, which is really good growth that they're expecting. And if we look at what other analysts are saying in terms of price targets, the lowest any analyst have given is $918. The average is about a 20% upside from here, and the high end targets is about 54% from here. And let's see what Morningstar are saying about this as well. They rate FICO as a 2-star company because of the price. However, the good thing is they say that it's got a wide economic moat, and this is something that's really important to look at when looking at companies, because it means that other companies can't just come out of nowhere and start copying exactly what this company does and essentially take their market share. Having a wide economic moat, it protects you from that. Morningstar give it a fair value of $1,500, so about $200 lower than what it is right now, and they've got some bull cases and they've got some bear cases. To conclude, I'm going to give you my opinion on FICO and what I've been doing. None of this is financial advice, but I'm going to explain why I've done what I've done. FICO is currently trading at valuations which are really expensive when you look at it fundamentally, and I agree with that, and I'd like to see FICO come down in price. However, FICO is currently trading about 30% down from its all-time highs, and I wanted to see how many times has FICO traded 30% lower from its all-time highs, and that's exactly what I'm going to show you right now. This strip at the bottom, it shows you how far we are from the all-time high. So from the peak to where we are right now, you could see on the axis over here, we're sitting about 0.3. That means 30%. And if I zoom out from the chart, recently there's not been many times. There's been a few times where it has come down to this level over here, and that corresponds to about 37%. And if I zoom into the chart right now, and if I was to mark out about 37%, we are talking a price of about $1,500, which is equal to what Morningstar is saying in terms of their fair value. And now I'm going to add some moving averages. Adding on the 50-week moving average and the 200-week moving average, FICO is currently trading below the 50-week moving average, and it's higher than the 200-week moving average. There has been a few times in the past where it has touched the 200-week moving average, and those have been really good times to buy, except for maybe this bit over here where it continued going down, but it did rebound fairly quickly. So I'm going to be keeping an eye out on the 200-week moving average. Then maybe that might correspond to a price close to about $1,000. That's one price that I would love to buy FICO at. However, it's already down 30% from its all-time highs, and it's very hard to tell whether it's going to come down all the way to $1,000 because FICO generally doesn't go down that much. The other thing is we're currently trading below the 50-week moving average, and I've showed already that there's not been many times where it has been trading below the 50-week moving average. So I think at this level it makes sense to start DCAing, and if price does continue coming down, then increasing your actual DCA amount. From everything that I've told you, a quick summary is expensive right now fundamentally. However, on a technical level, it's not been to this moving average very often. So what my plan is currently is I am DCAing into FICO. I'm putting in £50 every week into FICO. It started coming down below the 50-week moving average, and my plan is when it starts coming down to about 1500, the Morningstar valuation, then I will increase my DCA amount to maybe £100 a week, and if it continues coming down, then like that I'll continue increasing my DCA amount and hopefully build a large position in FICO, because I really think that this is one of those quality companies out there. They're doing all the right things, their management is efficient, they're increasing their free cash flow, and soon I think this is going to be a very big company. So if you've liked this video, please like and subscribe to help the channel grow, and I'll see you next time.